Hello everyone, this is Juan Sarmiento and today is Thursday, April the 20th. This is the second part of my series on covered calls, specifically how and why trade covered calls. So in this episode, I'm going to talk a little bit about the basics or the generics about options. If you think of it, what is a covered call? What is even a call? A call is an option to buy the stock at a date in the future, and grants you, it makes you obligated, or it gives you the right rather to buy that stock at the specified price, regardless of whether the stock has gone through the roof. For example, we have Amazon here, right? And it's trading at $104.85. And I say, well, I believe that by August here, August the 18th, the stock is going to be worth a whole lot more than here. Let's say more than $110. And I'm willing to bet that that is going to be the case. And I'm going to pay a whole lot less than the price of the stock. If we buy the stock, here we have the current price is $104.99. So I click here, buy, and I get an order to buy the stock. Okay, here it is, the stock. And how much am I investing? Well, $104.97 for 100 shares times 100. You can buy less, but I suggest that in most cases you want to make 100 shares so that you can sell calls against it, and we're going to cover that now. Okay, so that's my stock. What if I buy the option instead? So you take a look at the risk graph. The risk graph is the price you're going to make or lose versus the current price. So if the stock goes to 110 here, you would be making $493.98, and so you would have to hold the stock whether it goes up or down, but eventually, hopefully, it will get there. But then it could go down too. But in the long run, a company like Amazon, you suspect that it will go higher and exceed your price. Now, if you're going to buy a call, what happens then? Well, you have to establish what is your target date for that price to be reached. So let's say August is my target date. For whatever reason, I know that that's going to happen. Well, no, or you have a reason to believe that. Well, if you buy the option, you see the options here, you have different prices. So you can guess that it's going to be more than 110. So you can buy that option. And I click on the ask. And for the right to buy the stock at 110, at or before August the 18th, you're going to pay $7.20. And that money you would never see back again. You would see it if the stock goes high enough. Okay, let's presume now that we move forward into the future and the stock hits 110, 120 here. Well, now you have made, with your $7.20 investment, you have made $889. Okay, right here in this pink line. This pink line means somewhere right now, somewhere in the future, or right now. It would change very little, but eventually it would make the blue line, which is the expiration, at expiration. And you can see here it says at expiration. That's the blue line, and the pink line is today. All right, so if it moves very quickly, you can capitalize on that and get $880, which is more or less what you put in. You put in $720 to get your $720 plus $880. Okay, so there is something to be said. You can double your money very quickly, but you don't want to risk too much. You don't want to risk the $10,447. You just want to invest $720 and possibly double your money. Okay, if the stock gets there in the same location here, you would make something similar. Well, half of it, you make twice as much, $1,559, but you are also investing a whole lot more. The problem is options decay. They lose their value very quickly. Plus, there is, as you can tell, there is a value, time value here. Why? Because there's no intrinsic value. There is no, this option at 110, there is no real value there. Okay, the stock is trading at much less, at $100. So what is this 110 and $7? Well, you can visualize that the $7 and $7.20 is fluff. It's a wish. Okay, you're paying for a wish that the stock will go more than 120, so to speak. And there are those who think that for that kind of a price, you can just sell me the option. If you sell me the option, then I get the $7.20 or more or less, you know, a little more, a little less, depending on the bid and ask, you know, what the market is doing at the time. And this $7.15 will evaporate. Why? Because unless the stock goes up, this will decline. However, if the stock does go up, then there is an intrinsic value, a value that you could buy that option, and you could exercise that option, meaning buy the stock at the price of 110, and if it is more than 110, let's say 111, the $1 difference, that's an intrinsic value. It becomes intrinsic value because that option has a value now, being in the money, meaning it is higher than your strike price. Being in the money means it has intrinsic value. The good thing is that this platform tells you what that is. If you say add simulated trades, you can set here, make sure you set it up here, layout, and you see that I have position, intrinsic and extrinsic. I can change this to see other parameters, but right now I can see intrinsic and extrinsic. Well, this option that I'm talking about has no intrinsic value. So the $7.30 is extrinsic value. And that extrinsic value I want to sell to somebody and say that will eventually become zero. That extrinsic value will become zero. And then you are, as a trader, you're saying, I don't care what happens to the stock. I know that that will go zero. So I'm starting with $7.25 in my pocket already. However, if it does go up and you're selling that option, if it does go up, then the intrinsic value will increase and then you will be losing. But as I said, if it goes to 111, you're losing $1, but you already pocketed $7.30. So the difference is $6.30 that you are going to pocket. Now you multiply that 100 times because one share of the stock controls 100. One share of the option controls 100 shares of the stock. It is a contract. One call is a contract that to buy or sell 100 shares. Now, on the put side, we will deal with the put side at a later date, but it's the opposite. It's the right, you're buying the right to sell, okay? But we will cover that later. Let's not get confused. Let's focus on the cover call now. All right, so you can see that if I own the 100 shares, and on top of that, I sell the extrinsic value, I'm getting this $7.30. Now, you can repeat this over and over and over again, and you will be accumulating that $7.30 month after month after month, provided that they expire every month. So then I say, well, let's go over here. Let's go to the May options because they have less than a month to expiration. That means that that value, that extrinsic value would erode quickly, wouldn't it? Yes. Okay. So forget about the August. It's the same principle with an earlier date, but the decline of that time value is faster 1 month to expiration. So we're going to get less money for this option when we sell it, this May 29, but it's going to erode faster. Okay, and that's what we want. We want to go, okay, I could sell this call here, and then a month from now, when this option the extrinsic value goes to 0, I sell another and close this one, and sell another and close the other, and then I go month after month of accumulating this amount. Okay, so let's figure this out. Let's do it. Okay, let's say I want to sell a covered call on Amazon, and I'm getting $2.91. This is the extrinsic value. That's what I get to keep right off the bat. Okay, but look, there is even a higher one here at 105, because that's exactly the price. We are very close right now. So I'm going to select this one simply because it has more value. That means I'm going to get $500 right off the bat. Okay, so let's try that. Buy cover stock. Okay, buy cover stock. There it is. Here it is. And it says that this position is going to cost me $99.70. Okay, compare that to the current stock price. Is much less. It's precisely $5.75 less. That means that I already pocketed that extrinsic value. And what happens then? How come I'm getting this? How come not everybody does this thing? Everybody should be doing covered calls, you figure, because you're getting a much cheaper price. Well, the reason is very simple. If you take a look at the risk graph, let's reset the chart, reset the slices, and you can see the bigger slice is 1 standard deviation. The lower slice is 1 standard deviation below the current price, and the higher is 1 standard deviation above the current price. And here is the current price. You see how much there is this curve, and then it flattens out. Okay, so there is a limit. There is a limit to how much money I can make, and that's enough for somebody to say, well, you know, we're in a bull market. Surely Amazon is could tomorrow explode and go to $130 on a piece of news. We're in a bear market after all. Why would I sacrifice that potential trade, potential earnings, and compare it? Just click on the ask and look at the risk graph. Forget about the cover call for a minute. I deselect it here, and look, it's a big jump. If it goes to 130, I could be making $2,526. Why would I limit my potential gain here? Why would I do that? And here is the kicker here. Don't think about losing money. Think about a different way to trade. You can have your 100 shares elsewhere. This is, you set 2 accounts. One, just to keep it in mind separately, you buy the stock for one account, and you sell a covered call in the other account. Okay, so it is a different way of trading altogether. And what we're going to do in the months to come is every month that comes, I enter this May 105 call. I pay, as you see, $99.70. A month from now, on May the 23rd, I say, well, now I'm going to roll over my call, which means I close the call that I have and I sell a new one. If I close that call close to expiration or at expiration, the extrinsic value that I would pay for it will be 0. The extrinsic, not the intrinsic, okay? The intrinsic is already in the 100 shares that I own. And then I sell a new call, I'm getting $5 back, okay? So I invested $99.70 times 100 is $9,950, and I'm getting about as I said, almost $5, $4.97. Let's say $5, okay? So you calculate, let's use a trusty calculator here, and I invested, I'm getting back $5, okay? But I invested $9,970, so I'm getting about 50%, 50 cents, 5 cents, I'm sorry. That will be percentage, okay? So it's 0.5%. Let me see that. Okay, so I'm getting $5 times 100, so I'm really getting $525. 502.5, and divide that by 99.70, okay, times 100, that's 5%, okay? So that's what you are doing. Every month you're getting 5%. Multiply that times 12, that's 60%. Suddenly it becomes beautiful, doesn't it? Suddenly it becomes very profitable. The only problem is you're going to say, well, I would get a whole lot more if I kept my shares of Amazon. If that's how you think, that's fine. That's a different way of thinking about it, okay? I'm just teaching you covered calls because you want income to come. You can also, let's say, buy a CD and you're going to get 5%, but in a year. I could get the 5% in a month, okay? Or more or less, let's say 300, 500. I would say, well, you know, if I could get $500 a month, add that to my Social Security income, and bingo, I can, it's, you know, I have spendable income, okay? That is the purpose. So stop thinking about it as covered calls, as limiting your stock, and think of it more like a different kind of account. Keep it in a separate account so that you don't mix. You can have your stock only account, that's fine, but then have another one that will give you that value. Okay, now let's see what on that extrinsic value. Where does this come from? Why is it so high? Well, it depends on the volatility of the stock. What do I mean by that? If the stock moves a lot, then you have the option traders buying protection. They may buy precisely the covered call and sell the covered call in order to protect their stock a little bit. They might buy puts on top, puts in order, just in case the stock goes down, I'm paying $5 to protect myself. And so you can see that if the stock moves a lot, the option traders are right into it, and if the market as a whole is going volatile, meaning it's going up and down a lot, then that option is going to be expensive. So this is Amazon, which is fairly volatile. Okay, let's put something like GE. I think General Electric would be something with less volatility, and let's look for that. It's a similar price, perhaps a little lower. Then it's 300. You're going to get $330, a little less. Okay? Look for stocks that are less volatile. Okay, let's see. I don't know right now. I'm just looking. Okay, this is Delta Airlines, for example. Look at this. The extrinsic value, and note that I'm looking for the option that is in the money. The extrinsic value is $1.15. So you want stocks with options that have a big price. Now, how do you come up with that? How do you determine? That is the implied volatility. That is what tells you how much the option should be worth. If you scroll down, go to the trade tab, which is essentially the same chart, okay? And you go over here and it says today's option statistics. You can see 52-week IV low. Current implied volatility percentile, it says 4%. What does that mean? Well, you need to look at a chart, because I have a chart here that shows the implied volatility, and you see that it's way down here compared to what it's been And this is an option here that has been, even this year, as high as 97 in the 97 percentile, meaning has had very high volatility, or here 77, or here 67, or here now is 48. It's still pretty high. Now, oh, I'm sorry, that's Apache, that's not even Delta. I don't know why it came to Apache here. But you can see that with this chart, the IV percentile, you can see whether that IV is high. Let's look at the Delta. DLA, DAL. Okay, right here it's 33%. Okay, a volatility, let's say something like, let me think of a stock. Well, I was saying GE, let's try GE, it might be higher now. Here it is. Something like GE has been moving nicely up and up and up. And look at this, the implied volatility is low down here in the 28. Something like 20, let's try Nike for example. Yeah. Here we have Nike's very low volatility here at 25. So we are not going to get much. How about Apple? Apple is low, is at 28. Okay, so you consider low volatility. If it's below 30, that's low volatility. Anything above 40 is high volatility. Okay, so think of it that way. If the volatility is low, and you can see it here in this chart that is at the low end, what that means is that the options are relatively cheap. Yet we get 5% anyway, $500 from it on Apple. How about Amazon? Yeah, and you can tell, I'm going to give you instructions on how to get this chart, but you see that I have colored it. If the IV is high, it turns red. When it's low, it turns green. Okay, and here it shows you 44. That means we have a high implied volatility. When do you get high implied volatility? Well, as you approach earnings. As we're getting closer to earnings on Amazon, the volatility picks up. And why is that? Well, because the earnings may disrupt this price of the stock. It may be shoot up or shoot down. And look at this. Here back in April, it went down. Completely unpredictable. It was negative. Then here, negative again, yet the stock went up. So that's completely unpredictable. Here it went down, the volatility spiked just after earnings, and then it immediately dropped. Look at, immediately drops, and it drops a whole lot more if the stock goes up. It drops less if the stock goes down, but it does drop. So you can see that you need to be careful, because in advance of earnings, the stock can move up or down, and your volatility will increase, but it will come down right after earnings. So we need to keep that in mind as we go. But in any case, you can choose what options we're going to buy. And let's look at some stocks historically. Okay, let's start with JP Morgan. And then we can see historically how this stock has performed. Look at the earnings and how the volatility spikes and then goes down right after earnings. Here it goes up and then immediately goes down after earnings. As the stock goes up, the volatility drops. Okay, that's sort of important. You see the ups and downs of an option. So we want to sell that option when the stock is down here. Why? Because the volatility is going to be high, and high volatility will increase the extrinsic value of the option. So that's when we want to sell it. That's the reason to sell an option. It's going to be excessive. People are upset, people are nervous, and they start buying puts or selling calls against your stock. Well, you want to do it exactly. Sell your options when the volatility is high. Let's look at Baidu. And you can see how down here the stock is nicely up and up and up, and then suddenly it declines here, and the volatility is high. Okay, so if down here you have the courage to sell a covered call, you will be paid off as the stock goes up. That option will decline in value, but you already sold it, and you can keep doing it month after month. That's the whole purpose. Now we need to know how, when to sell that option. Well, it's better to sell it here when the volatility is peaking, rather than when the stock is high up here and the volatility is declining. You want it when it's peaking. Okay, let's look at another one here. AMAT. Same thing. Look at the high point. When was the high point in the volatility? When the stock was at the bottom. Okay, now you might say, well, when the stock is at the bottom, that's when I don't want to buy it. But you're buying and selling a call. That's different than owning the stock, isn't it? Because you're taking advantage of that volatility. And as the stock goes up, the volatility, the extrinsic value of that option would expire. But the intrinsic value of the option would increase with your stock that you own. Okay, so it affects you less. So that's the reason why you want to own the option and sell the stock and sell an option against it. Okay, so that's why we do the covered call. Let's look at another here. COF. Look at the pattern here. The stock is down, the option is really expensive, and then you're selling it. Here we have COF. Look at the volatility here as the stock reaches the bottom, and then it begins to go up a little. Okay, and then it goes down. Now you might say, well, if it goes down, you lose the value of your stock. No, because you're planning to hold that stock indefinitely. So it will go up and it will go down, but the option every month will go from extrinsic value $300, $400, $500 to zero. And the intrinsic value of that option will go up with the price of the stock. And I'm going to show you a trick as we begin to enter this trades, how to make this rollover so that you get the most value in the option without worrying about the price of the stock, whether it goes up or down. Okay. Now you might say, what if the stock goes to zero? What if it's one of those stocks that went, like Lehman Brothers, or in its time back in 2008, and it went to zero, or those stocks that I already forget that they actually lost all their value, went to zero. Well, that's the risk you're taking. Okay, it's not without risk, but let's try to then pick stocks that you believe are here to stay. Okay, so I go here, look at the Apache here. It's at the bottom here. No, it's not. But let's say if it was here at the bottom, and I believe in the company, I have researched it, and I happily own the stock, then you can sell a call against it. And you want to own shares, keep it in your different account that you have for holding stock, so that you don't equalize and you don't mix your belief that you need to have the stock without an option protection so that you get the most value out of it. No, that's a different story. Okay, this is the way to trade option calls. All right, so I'm going to stop here, but I would suggest that you look at my first video in this series, and that you keep visiting this video as well, so you remind yourself what are these principles that I'm setting forth here. In the next videos, we'll discuss more about implied volatility and how to choose that, how to come up with a list of potential trades to enter cover calls. Okay, thank you very much for joining me, and see you next time. Bye bye.